Hi everyone, my name's Liam and I'm part of the marketing team at Netwealth, and thank you so much for joining us today for this Netwealth Practice Management webinar. It's part of our monthly series designed to help wealth professionals discover new opportunities to enhance their business. Today we are delighted to have Rob Jones from Peloton Partners present for us. He'll be discussing pricing considerations and finding latent value in your business. But before I hand over the mic, I will just quickly run through some important housekeeping items. There is one CPD point allocated for attending this webinar. We've got a bit of a different way of sending them out this year. At the end of this presentation, there will appear a feedback survey. You will need to complete that to be eligible for your CPD point. The CPD point will then be emailed to you within a week of this presentation finishing, and also in that email will be a recording of this presentation as well as the slides. There will be some time at the end of the session to ask questions for Rob. He will try and endeavour to answer as many as he can. You'll notice on the toolbar to your right that there is a taskbar and a question panel. Please just answer any in there. And if you are planning on posting anything about this webinar on social, we ask you to please include hashtag NetwealthInvest or @NetwealthInvest. Before we get stuck in, just a little bit about Netwealth and who we are. We're nearing our 20th year over here, and we're an ASX listed company who provide an online platform to support financial advisors with a wide range of financial products and services to help you manage your clients' investments and superannuation. So partner with us and experience an award-winning platform to start running your business the way you want to. Some of these features include a market-leading advisor and client portal that is intuitive and easy to use, and access key info on the go with our mobile app. You can also experience a wide range of investment options such as managed accounts, plus advanced transaction tools such as automatic ROA generation, model portfolio rebalancing, and automated account and cash settings, a suite of detailed reports that can be tailored to your client and business needs, and access to unique insights designed to help you grow your business. Now, on to our speaker. I have the pleasure of introducing Rob Jones, CEO and Managing Director of Peloton Partners and also founder, who are a consultancy firm that reviews, designs and implements sustainable strategies to advise practices of all sizes across Australia. Previously, Rob worked in the police force before moving into the financial services industry, where he held positions at the Moneymakers and Shadforth Financial Group before founding Peloton Partners. But today he is your webinar host, so please, I'll hand it over to you, Rob.
Thanks, Liam, and good morning, everybody. Money Managers actually was that firm that no, that's absolutely fine. Doesn't really matter anymore, but yeah, thank you. Good morning, good afternoon, folks, and thank you very much for listening in. Over the next half an hour or so, I hope to give you as much information as I possibly can. I don't claim for a minute, nor my business, to be an expert on everything, but we are experts on pricing advice. We are experts on getting your clients to pay the fee that they should be paying, no more, no less. And we have currently done that for over 8,000 clients. So that is our claim to fame, and I look forward to giving you the information today that hopefully will make you think a little bit differently about your business. I think we're all confronting the Royal Commission that came handed down yesterday afternoon, but most of it was assumed, I suppose. There wasn't anything too dramatic. There's no point and no value in me rambling on about that because there's a lot of press floating around at the moment. So we'll get into it, and hopefully you'll find this of value. And once again, thanks for your time. So I've titled this "The Value Within," and it's an important title as far as we're concerned, and you'll see why as we progress this presentation, and certainly at the end, I hope that it makes sense to you then. But first, just a little bit on the Royal Commission, but also the business environment that we as advisors all operate within. My business, we're consultants, sure, but we actually come from an advice background, owning financial planning businesses, working as advisors, working as paraplanners, working as admin team members, as owners as well. So we feel we're in a reasonably good space to advise you. So let's kick on. So the findings, as I said, no real surprise there. The interim report was fairly clear in terms of giving us a heads up as to what might come. None of it is relevant, of course, until it's enacted into law, and that's going to happen soon enough. Our view is simple, and I, heard someone this morning, a broker come online, a mortgage broker, saying that her business will be devastated. No one will pay for advice. I've had some risk advisors say some similar things in the past, concerned where things are going. As far as I'm concerned, it's simple. Where there is a service, there's value. Where there is value, it can be articulated, packaged, priced, in particular to include profit, and communicated effectively to clients, and they will be happy to pay for it. So nothing changes since the Royal Commission. There is a requirement, obviously, for clients to re-sign up to the service that they're entitled to receive according to the exact wording each year, and detail the total fees that they will be charged. Now, this one is something that certainly for the firms that we've worked with, that you'll see some of their data today, we have been pushing this down the throat of them for the last 5 to 6 years, and have challenged all of the firms we work with, some of whom, many of whom apparently are on this call, so this won't be new to you. But we have always asked our clients to sit down every year with their clients and step through logically and with full transparency the services that they are going to deliver and the fees charged. Forget opt-in, forget FDS and all those requirements. I believe the highest position that you could ever hold is having that clear discussion with clients, and it should be an easy discussion, certainly for the firms that we have shifted so far, and eventually for everyone. So it implies, however, and I suppose this is a bit of an issue, we're going to talk about fees. My business of old, financial planning business, was a tiered, a percentage of funds under management model. So I'm not here to ram attitudes down anyone's throat if you are still charging a percentage of funds under management, but we will talk about that. We will talk about whether or not it is capable of pricing in complexity, pricing in service needs, and fully pricing an individual client. I can prove to you that it doesn't, but at the same time, it's your call as to how you wish to operate your business. However, as the paragraph there suggests, there might be a couple of issues, given that ability may be infringed, because in advance it's pretty hard to tell a client what they'll pay if they're fully leveraged to the market, because we don't know how markets will perform, plus other things in their lives may change. In any event, this presentation was not and never will be focused fully on the Royal Commission. It is focused on what we believe is the optimal model to be profitable, to be valuable now and in the future. It's an opinion piece, but I'll give you the facts. You'll get to see what everyone else is doing, in particular your peers, and look at some of the challenges that they've faced, that they've overcome, and that they're now sorting out. A little plug for my existing clients. Thank you for entrusting us guys with your business. I hope you are enjoying the hard rewards of your hard work and honesty. And yes, you're well positioned. Okay, what we're going to do: strategies and case studies to make businesses better, hopefully. But you've got to start somewhere. Understanding your business is obviously critical. The good bits, bad bits, ugly. Value proposition. For some reason, many firms seem to struggle with this. I don't think they should. We end up rewriting the value proposition for the clients that we work with only after we understand it fully ourselves. But when we do, it comes out reasonably succinctly. Pricing models that correctly price. So I'm talking about all components of your service, all components of the value you deliver, not just some. So we need it fully priced, and it'll be clear as to why very shortly. Profit is never a dirty word, and no two clients are the same, and neither should the price. It's an obvious statement, but I hope that you will always work toward embedding a profit in the client relationships that you have. Unfortunately, for too many firms, there isn't a profit embedded in enough of their clients for them to be sustaining a profit that they want and that they seek from their business for the risk that they have put up. So we're going to look at some trends around pricing, past, present, future, but let's just accept that the future is now. But we will look at some of the models, how they've evolved. We're only interested in the facts. In the Peloton era, in the last 5 years, we have looked after 70 firms. They are across Australia, metro areas, country areas, large, small, one-man firms through to 50 plus people within the business. But you're only going to see the real data based on these firms. We have also, in my previous job with Shadforth Financial Group, or SFG, that IWF now owns, looked at roughly 350 to 400 firms in that era. But here I'm going to focus on the 70 that we've dealt with over the past few years. Issues, challenges, opportunities, of course. How they extracted latent value. This is a really important one, and it may surprise you just how much value that you're sitting on in your practice. And if you think, as you're hearing this, that there is more value to be extracted, well then I'm definitely here to tell you that that is the case. It does not matter if we are in fair weather conditions or foul weather conditions. What we're going to talk about today is all conditions, and there is definitely embedded value in most practices, certainly the 70 that we've dealt with. And I think I mentioned valuation there, so that's important. So a quick little example here. How much value is there to unlock in your firm? So I can guarantee you that the 70 firms that we've dealt with, an average of 50% uplift in profit. If the firm made 100,000 last year, net profit, I'm suggesting there is 150 actually sitting there in the business within your existing clients, and it's your right to be able to extract that. And certainly we've found, I put a range up there, 17%. We haven't found a firm yet that doesn't have some embedded value to be extracted, and some have had massive amounts to potentially uplift upwards of 150%. And some firms we've worked with have doubled their profit. Again, having their clients pay no more, no less what is fair to them, certainly not fee gouging, and we are absolutely bullish on that issue. If we find that the firm is not servicing clients to the standard that they are telling their clients, neither should they retain that fee. I know it sounds a bit harsh, but that's the way we've worked for 5 years. These strategies we'll talk about, you can deliver that, or they can be delivered to you within 12 months. These aren't strategies that flow over years. They are strategies that can be brought forward, dealt with comfortably within a 12-month period. So you have to start at the beginning, of course. I'm going to show you and tell you how we do it at Peloton. If you are looking critically at your own business, your board of advice, then please look at the following attributes, because they are the minimum required in order to understand fully how your business is operating. We say we call it iFocus. So if there's and I probably admitted from the start, you may hear a couple of shameful references and self-promotion, but it's very difficult to give you this info without doing a little bit of that, so please forgive me in advance. But this is how we do it, and it's the only way I feel I can add some value to you. It's called iFocus, but do it yourself if you have to. So numbers tell a story. Of course they do. Financials give us a very clear indication how the business has operated over the last 5 years. If possible, we ask our clients, or even 3 years or even 2 years, we can discern some trends from that, and that tells us a hell of a lot. We want to look at how the business compares to the best. We are not interested in, and neither should you, benchmarking yourself to the average firm in this country. I'll show you some stats of what makes up the profit of the average firm in this country, and you're going to see immediately that there are some real concerns with the makeup of profit. So in our world, we look at every firm and we benchmark them to the top performing firms in this industry, and I'll show you some of the stats of the top performing firms in this industry. We want to look at how risky the revenue is, not risk insurance revenue, but how risky your revenue is. I'm going to talk to you about low value, low quality revenue, and it is a worry. So the leading indicators from the Royal Commission are clearly pointed at completely eroding what we term low value revenue, low quality revenue, whichever definition you prefer. We want we ask the owners, are they happy with the return that they've been getting, the return over the last 5 years or even in recent times? We do value a business, so you should know what your business is worth now, and absolutely what it could be worth tomorrow or should be worth tomorrow. That's the first part. The second bit is definitely a full sweep over the surface scope and depth of the business. How elastic is the service? Do we cover off on as many of the services that we expect that a full service client would expect or demand from the offering that we deliver? So how far does that stretch? How deep does it go? There are firms we're working with here that go incredibly deep when it comes to some of the services that they deliver. In particular, a couple of firms on the tax side are able to go incredibly deep, just as much quality as one of the big four banks, one of the big four accounting firms might do. Some of the firms, some of the financial planning practices out there go just as deep. They're quite incredible. So we want to look at how deep the service goes. Do you specialise? Is there anything else that you can skill yourself up on in order to specialise? Estate planning, most of us do estate planning. Centrelink strategies are very important for many clients. Aged care is a big emerging issue, and a lot of firms are getting themselves qualified to stretch the elasticity of their service. Does the business attract a wide variety of client types? We all need them. So is the surface scope big enough? Is the catchment area big enough to scoop them in? And does the business coordinate other specialists? Are you their chief financial officer? And I'll step through again a couple of examples of some firms that are absolutely outstanding that are out there that do effectively act as the chief financial officer for their clients. Call it a mini family office, whatever you will, but they deliver an incredibly encompassing service, and their clients value that, and their clients should pay for that. Your team. So we need to look at your team. We need to look at fees, obviously. Does the team possess the right mix of qualifications? Are there opportunities for development for them? All of this relates back to the quality you deliver to your clients. Are they paid too much? Are they paid too little? It's important that we understand that too. Does the fee model price in the value delivered by the team? Does the fee paid by clients reflect their individual complexity and needs? So those two factors, we believe, are the factors that most pricing models fail to capture. Individual client complexity, individual client needs in terms of how they want to be serviced by you. And there are, significant variances in that. Some clients are happy to come and see you once a year, come into your office. Others may require you to come and see them. Others may want that you interact with their other advice professionals. So there's very different needs that individual clients have. Most pricing models fail to capture that, and we think all pricing models should capture that. So again, here's some data on those firms, the 70 firms I talked about that we've advised. I obviously don't identify them. They're on the line. Some of them will definitely know that, but I'm hoping that when you look at some of these stats that you will sit back and perhaps identify yourself within those numbers. They do come in all shapes and sizes. One-man advisor with part-time CSO or admin support through to a much larger business, 10, 15 advisors within that practice. I've actually stripped out accounting revenue here and legal revenue. We've got plenty of multifaceted firms that we are working with, but for the purpose of this presentation, I've stripped out the accounting and legal revenue. Active clients. So passive clients no longer exist. They should never have existed in the first place. They are present in every firm. I'm not here to slam anyone who has passive clients, but that's old school. So we focus on active clients. Look, it's still around. I've just thrown it in as a measure just for a bit of scope. So 15 mil through to some large firms that are managing in excess of $1 billion for their clients. Profit fluctuated dramatically throughout all the firms that we work with. Negative 700,000 up to $3 million plus. Staff, as I said before, 2 through to 45. Tenure of the business, 2 through to 30 years. So we're hoping that most of what you hear is relevant to a firm, whether it's 2 years in or 30 years in, it shouldn't matter. And as I said earlier, all across Australia, one of the best firms that we've worked with is in a regional town in Victoria of 10,000 people. So if anyone here is from the regional areas, and we have managed plenty of firms in regional Australia, it does not wash over me one moment that your client should be paying less than what another client should be paying for a comparable service in the city. Absolutely not, and we've proved that thousands of times, so I hope I haven't offended you. But let's look at a single trait that embodied all these practices. Firstly, they deliver value. Out of 150 advisors that we have seen and worked with extensively over the last 5 years, I've come across one rotten egg. one individual that I was so happy and glad to be a part of this person's demise on the same day that I met them, for basically a crook. But it's only one advisor out of 150. And it just proves that there are so many quality advisors out there doing a fantastic job, working their guts out, delivering a great value to their clients. And people like this individual, who's now gone, shouldn't be in this industry. And unfortunately, too much legislation is focused on managing minorities rather than majority. But I was very glad to get rid of that individual, who was basically lying to the owners of the firm and saying that he was servicing clients. He certainly wasn't. And cheating clients as well. Anyway, good riddance to that person. I forget his name, actually. That's how insignificant it is. But the thing that does pull these firms together is that we could measure their value, we could describe it, we could price it. Clients pay no more, no less. And I need to ram that point home, because someone will invariably say, oh, you can't just ramp client fees up. We never do. We measure profit inside the service that they're receiving, and the client will pay that no more or no less. So let's just break down the revenue inside these firms. Of the firms we've looked after, around 70% wealth management fees, financial planning fees, if you want to call it that. Risk revenue accounted for 20% of the total revenue of these firms. Other fees. Let's have a look at the other fee bucket and just have a look how much this is going to change and should be changing and is changing as we speak. It comprises broking fees, volume rebates, passive income, product commissions. So effectively, for the firms that we've looked after, this was embedded inside the revenue of these firms. This is very much under the ire of the Royal Commission, and government no doubt will legislate very soon, but that's a significant number. So roughly $135 million is the cumulative value of all the revenue that of the firms that we've advised. That means that there's $13 to $15 million that is going to be wiped out in one form or another. And I really want to sort of focus in on this as to how we treat it and how we deal with it and what impact it has. Let's just break out the risk revenue for a moment. So of that 20%, 72% of it is ongoing risk fees, 28% of it's upfront. And that number has been trending down. Those same firms, by the way, 5 years ago, for those that have been in business longer than 5 years, their upfront risk fees were much higher than 28%, around the 45% mark. But because of the reforms, it's now 28%. And of course, that is legislated to reduce further. Let's break open the wealth management side. So of the firms we're dealing with, 91% ongoing revenue, 9% upfront fees. And ironically, over the past few years, that number has come down from around 13%. And one of the reasons we're told by firms that where we've recorded this, observed this, and asked them questions is that advisors have consciously charged less for upfront work. And it's probably one of the most common questions we get asked is, can you give us a guide around upfront fees? What should be charged and when? So we'll touch on a little bit of that, but there has definitely been a conscious effort to charge less. And the only thing I can attest to that is that advisors aren't sure and have elected to take a lower path for the client to come on board. So the main issues confronting the business environment of today, let's interpret the data. So this is the three largest themes that came out of a deep review of those 70 firms. First, new business growth has slowed. Just said that before, probably because of the issues we talked about. But for the last 3 years, it's been around 3% compound. That's not much, given that inflation would take that out potentially. 6% compound in the years prior. So a couple of years after the global financial crisis, as firms came out of that, clients were coming back into the mix. It's clear, but the data is fascinating. It's telling us that we've slowed up over the last few years. Part of that has to do with the risk insurance fees that are part to blame. Also, as I said earlier, financial planning fees have come back for no obvious reason other than advisors want to get clients on board and not charging much. The next item is rising business costs. Almost every firm we have seen, almost every firm, has had an average increase in their business costs of 15% over the past 3 years. Now, it might come as a surprise to you, but please look back through your P&L and you'll probably see this very clear. Obviously, there are some big contributors to that, and that is increase in salaries, that we're paying to advisors is one of them, but also wage inflation. Well, there's the wage inflation piece, definitely CPI in there as well. And a big contributor was regulatory requirements, complying with them. That seems to, it's only going to get slightly worse. If we read down all of the Royal Commission findings, it's going to be worse. So what a shame that we have to increase our clients' fees just to cover things like this. So the return to advisors and the return to owners is impinged by regulatory reform. It's insane. But that's meant that those same firms are flatlining profit levels. Quite disappointing. So slow new business growth plus the increased costs results in owners' income flatlining. And I'm yet to come across many fee models that can adequately deal with pricing in those additional costs to do business. It's a problem for many firms. We deal with that absolutely. It's the elephant in the room. There is every reason why we should be passing costs on. It is not our fault that the regulators are coming out and doing what they have done and causing us. Well, it's actually the fault of the very small percentage of advisors that shouldn't be advising, but unfortunately, it's life. So very few pricing models can factor that in. In a simple statement, we've got to modernise our fee structures. We need to ensure that we can stay competitive in the years ahead. There is impacts to valuation as well, and we can overcome that. And we need a proper fee structure to be able to do that, and I'll show you how to do that shortly. Three of the biggest issues. So let's just break open that profit for a minute. The Australian financial planning industry, the average of the firms out there, including the Peloton average, 25% net profit over the last 5 years. The US planning industry for firms under $2 million of revenue, around 24%, as you can see. And the interesting fact here is the top performing firms, so the Peloton, what we call our Peloton top 20% benchmark. We're not saying we've advised every single one of them, most of them we have, but they have metrics and they operate a certain way that generates a very consistent return of between really 35 to 40, averages out about 38%. So have a look at that 5 years now, from 2013 to 2017. This is just a breakout of that 25.4% average period, and we're just extrapolating it out over the years. There is, unfortunately, a bit of a trend towards a reduction of about 4% happening in 2018. So we haven't got the results out yet, apologies for that, but it appears there is a trend that it's getting slightly worse. But these are the facts, you can't dispute them. So, really important one, and I hope I explained this clear enough to you, but this is something that we spend a significant amount of time on to explain to advisors and business owners out there. So I hope it's going to be clear what I have to say. What you've got there is a chart on the left that says Peloton average 483,000. That's simply the average operating profit of the 70 firms that we have dealt with. Of that, $226,000 is what we classify, almost 50% of that, of the 483, we classify as low quality revenue. You strip that out, and it will be stripped out, and it simply says that those firms, the profit is so reliant on low quality revenue that when it's pulled apart, not much is left. There is not a significant buffer, and all of it has to do with the pricing model. It's got nothing to do with the quality of the advice. The advice is still good. It's got to do with the model not compensating as it should. But strip that out, and that's what it looks like. Conversely, you find the Peloton top 20% firms, they rely on that still, but it's at a much lower rate, so that they do have a bit of a buffer. What's low quality revenue? You saw it before. It's upfront revenue, and I don't mean that's in itself directly low quality, but it's non-recurring. It's upfront one-off. Product commissions, passive client revenue, rebates of any kind, volume bonus, loyalty bonus, marketing support. All of those aspects we have seen inside the 70 firms that we've advised in one form or another, and that is adding up, on average, to 50% of the profit they're delivering. It's high. It is also under further regulatory pressure. We say to the firms we work with, please don't rely upon this anymore. We are going to assume it's not there. It's going to be chopped out. We're not going to design a fee model that does not account for that revenue that's going to drop off. But it's also hard to replenish year on year. Upfront new business has slowed. We show you that it's slowed down. It's hard. So we need to do something about the ongoing fee model. Low quality revenue was to dry up, as I said earlier. Some of these firms are under immense pressure. The bottom chart is simply explaining that in very direct terms, but that little box at the right is the fact that we focus on models that deliver a buffer, so that the business does not rely on this low quality revenue of any kind, because we shouldn't. The next attribute of all of these firms that we've dealt with is unprofitable clients. They're everywhere, but no one can really point them out. We must get more sophisticated. We must be able to address the issue of individual client profitability, because that is key to everything. Every client should be profitable one form or another. Or if you deliver pro bono advice to those Australians who are struggling, fantastic, but you can't deliver it to them all. Even if you're discounting your fees to those that are struggling, fantastic, we support that too. But again, it cannot be for everyone. You must have a stated reason as to why you're doing that, and be clear about it, because I simply say that there should be an embedded minimum profit in every client relationship that you have. Change is tough. Excuse me, I was just having a drink. Change is tough. Of course it is. I've been talking to a lot of firms who ask me the question about fintech and will that make a big difference? I'm sure it will at some point, but I'm not 100% sure. I don't know whether it's going to help, bring on new clients in any way, shape or form, but it may help the inefficiencies in the back office to be extinguished by adopting a fintech mentality. But that's change, and many firms are waiting for others to make a move before they jump. But there is some good stuff out there. I don't have time to go into it today, but you can always chat to us later and we can talk about that. Blind inertia, hope. There are many firms who have said to me, and again, nothing against you, but firms have said, Rob, thanks, it's nice chatting with you, but we'll be fine. We're going to have a great year next year. And they may well, but a lot of it rests on hope. Hope's not a strategy, never has been, never will be. We need to get a bit more fair income, we say. Let's look at fee models. This is the elephant in the room. So I'll explain this to you. Up the top, of course, you've got the three different types. You've got a percentage-based fee model of funds under management, hybrid models, combination of fixed and percentage, and of course, you've got the fully fixed models to the right. So the average firm that presented to us still had a percentage of FUM model of some description. 28% of them, that's a full percentage-based model, I should say. 28% presented with hybrid models of fixed fee and percentage, and 32% were either fixed or advanced down the pathway. Of interest, again, the better performing firms were well progressed down that pathway. It is simply a fact. Whether we agree with it or not, this is the data and this is what it's told us. So there are many fee models that remain in operation still. The trend is very clear that fixed fee models that can flex with the changing circumstances of clients is definitely well underway. The best financial performance is achieved when you can price the service and value you deliver, no matter how much money you manage. Now, we have put in place 60 fixed fee models for clients, for firms, and they're all different because the firms are different, but they are fully fixed fees. They can flex with the changing needs of clients and their circumstances, and we believe that's important. And they can be every year reset with the advisor in front of the client as they should be, as what's going to be required in the next year or two. So let's look at that evolving pricing models and why they're evolving. So the progression of our industry towards a profession, if we're fair income, can definitely be viewed through the lens of an evolving pricing model that is actively being pursued now. If you think it's not, or you hear, or you believe it'll never sort of go to that level, well, I'm here to say that the ones that we're putting in place, no one has asked us to continue on with a percentage-based fee or a hybrid fee. They are preferring to move their fee toward a fixed fee engagement. This progression is natural. We need to get authentic, and fixed fee models do allow that. And I'm sure you can see with this chart that many of you are very familiar with it. My old business planning business, we had a flat percentage of FUM. We then moved it to a tiered percentage of FUM because we were trying to recognise perhaps that clients with more money, bizarrely, clients with more money seem to be paying less as a percentage, of course, as we try to work out segmentation. Many of you moved then to a tiered percentage of FUM and fixed fees, so it's a combination play to try and deal with that. And then there were fixed segments, gold, silver, bronze. Here's the package of service, here's what you pay for that. Everyone tried to sort of move toward that. But it is quite clear now that individual pricing that can flex with clients is starting to dominate the advice landscape. And there's a reason why it's doing that. To be able to service clients fully, including putting in a minimum profit, and I'll tell you what we do for firms a bit later on that measure, it can only occur when the pricing model is flexible enough. In addition, having the pricing model that can change as clients change, it, in our view, maintains a perfect alignment between advisor and client. And that philosophy, again, is simple. No two clients are identical in their needs and complexity, neither should the fee. So how do you describe your fees and value to your clients? This is another thing that these firms struggled with in terms of explaining to clients the value they deliver and certainly explaining their fees in relation to that value. Here is a couple of statements that we have done for a number of clients. They're all slightly different. That depends on the type of firm, but we think they're clear and they should be inside every FSG. One is value. Our fee is directly linked to the value we deliver by a highly qualified team whose mission is to understand what is important to you. We commit to delivering all the services to you, not just some. So the Royal Commission came out, talked about entitlement to service, that you are going to have to sit down with clients and talk about the service they're entitled and then deliver it. Well, this is the commitment you have to make. Fees should be simple. This is us talking to one of your clients, by the way. So our ongoing fee structure is clear, transparent, easy to understand and calculate. The fees personalised. It relates directly to the services you need, how complex your circumstances are and how you wish to engage with us. Therefore, you'll pay a fixed fee that may change as your circumstances change. Fair. As our fees are tailored for each client, they are fair to each client and they include a profit so that we can continue to serve you in a manner appropriate to you. We are here to make a profit. It does not matter, and clients do not mind if you include profit in that conversation. 8,000 clients that have gone through our model can attest to that. We haven't had issues with that particular issue. It's important. Profit is important. 5, our goal. The goal is to ensure our services are valuable to you and valued by you, and if at any time they're not, we'll assist you to go elsewhere. Any firm that works with us, we start with a full review of their active clients, and we say this to every firm, and this is what happens pretty much to every firm. 1 to 2% of your clients are going to walk out the door. They're going to walk out the door not because the price that you're putting in front of them, the new fee, is wrong. They're not going to walk out the door because they don't like you. They're going to walk out the door, and I'll tell you that in some cases, because they actually don't value what you do. And if that is the case, that's fine. If they don't value it, then assist them to go elsewhere. We want clients that value us, and we've proven that only 1 to 2% of your clients in your firm will test you on that measure alone. Now, this is a Beddoes, client survey. It was 2013. It's actually relevant to today. In fact, we could have put in another 20 different client surveys that talk about what clients value, and it shouldn't come as a surprise to you. The survey is obvious that interpersonal skills, this intangible value of advice, something that I want to talk about a bit later and explain how you define it, is a critical component of what we as advisors do. And this is out of 100%, by the way, each one of these categories. So 82%, it's so highly valued. Professional reputation accounts for 19%. The quality of the advice of the product, 17%. None of us should be surprised with the product piece on that. The tangible services, 15%, because they're expected. That's why it is like that. Knowledge and competence, 11%. Cost, another 7%. And technical skills, 4%. Technical skills are a given. Most clients assume that their advisor has the requisite skill and technical qualification. Cost is always pushed down where value is. Where there is no value, they're the clients that walk out the door. So cost is an issue to them, but it certainly isn't to the majority of your clients to any great extent. So let's talk about intangible value. When we design a communication strategy to every single individual client, on the very first page is not the things that advisors do, such as you might stick in your FSG or in your fee disclosure statements or opt-in or what have you. We put intangible value, the things that really matter, up front on page 1 because they're so important, because we're responding to those surveys where clients support it. So we simply say, don't make the services the call, let's talk about the value and why. Your clients do not have to be advised. they make an informed decision to elect to be advised. Most often the decision stems from an overwhelming need to feel safe financially. That's why that peace of mind features so strongly, and it is often in the decision making of most clients is that they need some help, they're a little bit concerned, they want to feel safe. And of course, we hold up one of the three most important pillars. It's clear. First pillar, of course, for your clients is their personal health. Their family and friends rate the next as they should, if not beside them. But the third one is ours. It is wealth, and we do command a high presence in the financial affairs and the lives generally of our clients. That's why intangible value is so important. And I guarantee you, if you fail to reconnect your clients back to the very reason they sought advice in the first place, which is often this intangible value, those clients start to build resentment. So another trait in the 8,000 clients that we've put through our pricing model, clients in your business, the trait around the clients, even good ones, that the advisor tells us is a really good client, well connected to us, etc., but those same clients have sometimes walked out. The advisor's been blown away, and the only reason the client might have walked is that they've been building up layers of resentment, little bit by bit over the years, because we have failed to reconnect them back to the very reason that they sought advice in the first place. And we all know as advisors that the minute we do something good for a client, the very next year or the next day, it's often forgotten. Well, sometimes they need to be reconnected back to that. That's what we do for every firm. Too many advisors underplay their value to clients. I get sick of this. You sit down with an advisor and trust me on this, I hope you do, but we spend at least 20 to 30 hours. So my clients who are on this presentation will validate that. They get sick of me, but up to 20 to 30 hours we spend individually with advisors. We're walking through every single one of their clients, taking a step back in time, talking to us, telling us about the journey those clients have had through the business in terms of the key issues that have happened over that time, or how their advice needs have changed over time. It proves two things. Firstly, the depth of advisors' knowledge of their clients is absolutely outstanding. It's phenomenal. Love hearing it. I wish the industry at Broad could hear it. I wish the clients that you serve could hear the way that you speak and retell the stories. But I often get a comment that, oh, look, I don't really do too much for the client, Rob. Gee, we charge $2,000. I really don't do much. It annoys the hell out of me because underlying all of this is the fact that your clients are staying there because they trust you explicitly, and you've earned that trust over time. Please don't undervalue. When you do, they will. So that comment earlier, regularly reconnect your clients to the reason they sought advice in the first place. It is critical for a two-way valued and valuable relationship to exist, we say. And the core of the offering, again, is that intangible value. But how do you express it? This has been the other challenge for a lot of advisors over time, the expressing of intangible value, because it's not easy. It's taken us as a firm, a few years to sort of work out properly, but we feel we've condensed it a little bit. And it's simply a series of we statements, each of which is capable of being retested with your clients. First, we're committed to understanding your needs, to give you the peace of mind that your financial affairs will be in order, to enable you to live a life you choose. It's exactly what we do. We are here to help you identify and clarify your unmet aspirations and goals. We are here to take stewardship over your financial goals and aspirations with you. We are here when you need us the most, at a time of a loved one passing or suffering a serious illness or disability. We are here on an ongoing basis to help you make informed decisions regarding your financial affairs throughout the course of planned or unplanned changes in your situation. We are here at the end of the phone when you need us. We stay up to date with legislative and economic changes and trends in the wealth management industry to benefit the advice we provide to you. Those we statements, in our view, defines intangible value. Clients connect with those statements. That is what they feel. I believe personally that we should be restating this as often as we need to with our clients. And because of this new requirement that you must sit down with your clients each year, tell them precisely what they'll receive, what they're entitled to receive, tell them exactly what they should pay for that. This should lead that conversation, in our view, as a recap. How am I going on time, Liam? Are we okay? Good, good. This is an important one. This is the Peloton curve. So we set up this curve model to determine the right mix of an ongoing fee strategy to target a minimum 30% margin. And this is what the best performing firms achieve. So we've taken the data across 10,000 clients, We've worked out exactly how that data, how that curve should flow, and we use it as a guide to measure your business, your clients, against the Peloton proprietary curve. I'm not saying it's an industry-wide accepted one, perhaps one day, but it is certainly one that we use as a yardstick to work out how closely aligned to it you are or how far you are from it. So on the left-hand side, it's got a percentage number there, as you can clearly see. Call it a fixed fee. It doesn't matter, fixed or percentages on the left. Down the bottom is fun. Why? It's at the moment an easy, recognisable metric that most advisors have operated from. And all this curve is doing is working out the best performing firms and where clients, what mix should be on the line, above the line or below the line to drive the right profit model back into your business. And this is the mix. So 20% of the clients, because you individually price them, will come under the curve. And they may come under the curve because there is a reason you want to discount the relationship with that particular client, or their needs are very simple and you wish to price them accordingly to their needs and complexity. 30% typically sit on the line, 50% are above the line. That is the mix that the best performing firms would typically price their clients at, above or below this curve or on the curve, and it drives around a 30% profit margin. And again, 10,000 clients make up this curve. The variance above and below, as I said before, reflects the customized pricing at the individual client level. That's why it still curves. So let's look at one of my clients. They're probably on the line. They will know what the numbers are. Sorry, guys, if you are. Actually, it doesn't really matter because you're well beyond that now, but this is this client. They charged a percentage of fee model. They also had fixed fees in there. They had a hybrid in there as well. There was a bit of confusion, inconsistency. It's no big deal. It's the same with many, but this is how they presented. So we looked at their clients and where they sat on this curve, which is really important. So when we map their individual clients, and you're going to see a heap of dots come up shortly, the dots represent precisely every single one of the clients, the active clients of this particular firm, and this is where they sat relative to the curve. This firm's delivering great value to their clients, but 65% of them are below where they should be. 65% of them represents maybe a profit. Yes, there's probably some in there. I'm not sure precisely how much, but it's not a lot. Far too many of them, though, are below the curve. This firm, and I think I've got it in a little box here, was consistently delivering a profit margin of under 20%, or at 20%. But half of that revenue again was low quality revenue. So we were presented with a bit of a challenge here. We had to turn around the fortunes of this firm. They weren't happy with their results. They felt they were delivering great service, but they always felt uncomfortable with where their client fees are. Well, we told them exactly where their fees sit, and we needed to do something about it. So this is what we did. We calculated the following. We calculated the value they deliver. We calculated and looked at each of the services they offer, the depth of those services. We looked at the team, as we do. We speak to every member of the team. We want to understand their competencies, qualifications, tenure, etc. That's relevant. We looked at every individual client and their service needs and complexity and the target profit that this firm wanted. And we put together a fixed fee, but it can flex, of course, with clients changing. And then we shifted the clients. Now, this firm is still in the Peloton implementation phase. They will end up roughly like this model. Probably not identical to it, but close enough to it. But they're well on their pathway now. As you see that comment in the corner, they're about 32% at the moment. They'll probably stay that or just around the 35% margin for their ongoing service, not their upfront, for their ongoing service per client. I hope that point is clear. This particular firm had clients that sort of fell into a segmentation approach. I'm going to give you 3 different variants now on a fixed fee strategy. One happens to be a segment approach. It's fairly basic. It should be basic. It should be clear. Fun, always only a guide. It should never drive the discussion. The next factor should drive the complexity and where the client should be. You can see them there. I won't read them out. You're going to get a copy of this anyway. But we needed to make some clear statements so that the firm had a guide, that the advisors in the firm had a guide that they could work towards. And down the bottom, that ongoing fee, the minimums must be 3, 6, 6, and 12 inside those services, because once we put a client in there, and it doesn't matter if the client had 100,000 in FUM, that client could well be a gold client if they have a bucket load of complexity. It's not the size of the client, it's how they engage, it's what issues come with that client. And you know as well as I do, if not better, that a lot of clients have a lot of issues and need a lot of servicing. So all we say is use it as a guide fund, but look at the services, value your services, and then make sure you target and price your clients right. There's not many firms that can make a profit under 2,400 or 3,600 as the basic minimum cost to serve. Everyone talks about it. We've looked at time cost average, profit, and a whole range of factors. That's why for our clients we typically raise the bar to the low end, or the low FUM end of the market, so that we can truly price it in. There's a bit of an upfront guide there as well. What about the additional services? This is just all the services that sit with that pricing model under a gold, silver, bronze, or whatever you want to call it, platinum, silver, bronze. And there was an existing client one that we had to put in for this particular firm, but it's not something that they don't bring any clients in on that. It's just existing clients that may sit there. This is where we had to change the service for them. And then this is a classic case of a typical segmented fixed fee approach to pricing advice. The next is a layered approach, and this is really important to have a logical discussion. Just imagine yourself sitting here, 5 minutes to go. Gee, I better fly. Thanks, Lam. This is if you're sitting in front of your clients next year when you have to represent your service to them and you have to put a fee over the top of that. Take a layered approach to it, which we've done for some clients, some firms, and it's worked really well. Talk about the base fee. Intangible value comes into the equation. Trusted advisor understands me, my concerns, challenges, needs. An advisor who will proactively contact me, something we're not doing enough of, by the way, but that translates as peace of mind. On-demand availability, my advisor's there for me in a personal or financial crisis, be it planned or unplanned. My short and long-term goals are always in focus, and it is about the client. When you hear people say advisors should never charge a retainer fee, or what do they do for their fee, well, all of those factors are embedded in every relationship we say. They can be valued and priced. But then you want to add your standard service package or whatever your service package is on top of that. So we're building the fee. We're not coming in with here's your $6,000 fee, that's it. We're coming with a natural approach of how we break the fee down into its constituent parts so that we take a client on the same journey. We add our service package to the base fee, and we'll get ourselves a fixed fee. You should link it to CPI. All the firms we work with do. But then we should look and individually price these factors in that are all too often forgotten. Client complexity is a big issue, and their needs. For example, an out-of-office meeting. We say you should charge that client more. It's simple. Why should that client pay the same as a client that comes into your office every time? They shouldn't. Client complexity. Some clients, as you know, present with multiple complex tax structures. They should pay more. Out-of-scope service has been demanded or evolved. They should pay more. Any additional or reduced service needs as their lifestyle changes. Revisit this every year with them. You're going to have to soon. Non-standard portfolio requirements. We've got some firms doing amazing things around the investment strategies for their clients. But if their clients require a non-standard approach, then charge them for it. There is nothing wrong with that. It should be the case. Intergenerational support. We've got plenty of firms we work with that are putting together philanthropic and charitable structures for their clients who have a bent towards that. Here is one further approach. So, sorry, the end there is that's a truly bespoke fee. Apologies, I'm trying to rush you. I'm running out of time. I've spoken too much. But that's a second approach to building a fee and having a discussion with a client about what it is that you do for them. The next bit is a service menu approach. We're doing a lot of this to price clients at the top end of the market. Top end of the market. Down the left-hand side, there's an intangible value, what really matters, retainer fee. There are the tangible things that we do for our clients. This differs for almost every firm, but a lot of firms have some similarity here. We've gone to the market, we've put a price on those monthly, we've put a price on those annually. This is what you should be charging. The reason these are the factors we base price on: the time cost of advice, value delivered, additional services offered, special needs or circumstances of clients around other experts. We've added in profit into the equation here for every single one of these services, and we've reviewed them against industry benchmarks to make sure we're on the spot. Here's an example of a firm that then applied this. This is what the client saw. This was in a PowerPoint presentation, going to a particular client to explain to them precisely what they're buying and what we charge them. This client was paying $12,000 to their advisor, $1,000 a month. Well, we priced this client at $19,000, and you might think, well, that's ridiculous. What was ridiculous was $12,000 was not adequate enough for what this firm was doing once we broke it down into each of these categories and found out precisely what they were doing for that client and how complex this client was. $19,000 was the correct fee. The client paid that fee gladly because the value was clear. The services they were buying from the advisor is clear. We do a hell of a lot of this now for many of the firms that we work with. And the biggest thing, of course, is anyone can put a number down, but you've got to be able to communicate it with conviction to your clients. This is just giving you an example. So we've looked at the reason you may need to make some changes. Now we must look at how that happens. This is what we do for firms. Apology again for the shameful self-promotion. It takes us 3 months to get a firm ready, whether it's 1 advisor or 10 advisors, and we make no excuse for that. Even though we consider ourselves expert at pricing advice, we need to implement these strategies and run the project for these firms because they don't have the resources to do it, nor necessarily the expertise. This is how we do it. Obviously, we look at the value proposition, we make it clear, we train up everyone, reception through to the MD, on that aspect. We amplify the important components of value. We say intangible and tangible are critical to be infused into your pricing model. We identify those clients who are mispriced, underpriced, overpriced, and work out why and what to do with them. The plan is then communicated with all the team and the steps very clear. Every client is reviewed individually with their advisor to understand what the impact to that individual client will be and what tactics we must use to communicate that to the client, and what happens if the client turns around and bucks you up in the meeting, and how do you respond to that client. This is the next bit. We conduct objections handling and scenario training with advisors to equip them properly. If any of my clients are here, I'll put anyone else onto them. They will tell you what this process has been like. It was bloody hard at the start. They loved it at the end. There's a bit of work to go through, but nothing ever happens and nothing's ever easy. But once you get in there, you'll soon understand that it becomes a much more fluid conversation with your clients, no matter how difficult. And you've got to implement a plan. Have a start date, have an end date. We monitor weekly at the advisor level, at the group level. We have 13 firms around the country right now that are in our I deliver phase, if you want to call it that. That's what we term it. And they are doing exactly this. And they are as far as in Townsville in the north, Hobart, Perth, Sydney, Melbourne, doesn't matter, country Victoria, country New South Wales, country Queensland, everywhere. We report all of this obviously to the team every week. Most of our firms, the advisors get together with the team, they talk about how they're going with this whole exercise. They work together as a group because it's so important to them. Celebrate individual milestones along the way, mission complete. That's how it gets done. A couple of quick case studies I'm running behind. This is one firm. This firm is completed. A brilliant guy, terrific advisor, another part-time advisor, and a couple of admin team members. $850K he was on, fairly good margin at 27%, but he didn't feel that the $230K, which was his whole salary and dividends, was adequately rewarding him. There was clear value in his business. We did our typical strategy, and he was up now at 36%. He's made $120,000. It's not just about money. It's about how the attitude has changed towards the value and service delivered. Second firm, you're going to see this anyway. You can read it, but this firm is still going. So revenue of 1.6 million. They had a profit around 20%. It's the firm actually that I showed you a bit earlier on with the Peloton curve. They've got a $250,000 uplift. They're well and truly on the way. That will be done and completed in about 2 months, I believe. The third firm, this one's done, single advisor business. Yeah, you can see it there, $500,000. Profit about 140K, 25% margin, and they had $150,000 improvement to their bottom line. So that's just an example of 3 firms. Again, apologies, I've got to speed. So here's some benefits quickly for evolving your strategy. Firms who have evolved the pricing model have evolved their conviction and offering along with it. This is critical. And when they do, this is what happens. The value proposition becomes clear. When the capability of the firm is unpacked, analysed, and we restate it back to your clients, it leads to conviction around what you do. Clarity, the model and team structures required to deliver the service become clear, and we're focused on value, not volume. Often it fixes up issues in the back office. Transparency, it's unrivaled. Clients know exactly what they're paying for and why. Fairness, clients are paying their fair share, no more, no less than what they should, and there is no client funding another client. That is wrong. Improved cash flow, profit, business valuation. We are valuers as well, accredited valuers. I do one for every firm. So 70 of my clients have had valuations, both now and then once they've done this. 3 of them are sold during that period. They got exactly the fee that we thought they would, that they deserve for selling their business. But that's important that it impacts these metrics as well. Final page. There is little room for complacency anymore as rapid revolutionary change is occurring and will embed greater protection mechanisms, and that's obviously happening now. The evidence is clear that there is significant latent value sitting in the average firm across our industry due to the inability of pricing models to price all the factors. A percentage of FUM does price some factors. It certainly doesn't pick up the factors of complexity, service needs and service expectations, and they are relevant. Reconnecting your clients to the reason financial advice is so relevant for them and why your particular service is so important to them has never been more urgent. I wrote this 4 or 5 months ago, so it's got nothing to do with the Royal Commission, but some of the stuff has sort of come out. But if we need to convince you first, we will. When you are open, honest and fully convicted about what you do and what you need to charge, your clients will pay a higher correct fee when the facts are presented to them and the value you deliver is clear to them. I'm not talking garbage here when I tell you that at the extreme bookend of what's achievable, there is a single advice firm with 3 support staff that was charging one of their clients out of 50, $48,000 or $4,000 per month for the offer, $48,000 ongoing. We came into the same process. We valued that client after pulling the client apart, putting them back together again at $96,000. So that's a double in the fees. That was presented to the client and the facts were very clear as to why, and that client agreed to pay an additional $48,000. And before anyone screams down at me to say you're ripping them off, it's far from that. This advisor was a full CFO to this client, acted as their mailhouse, acted as their chief legal officer, chief liaison officer, chief financial officer, everything. The client was solely dependent on this advisor, and the advisor, as nervous as he was, simply put the facts to the client, and the client was overwhelming in his support, agreed to go. Not all of your clients go up by 48,000 though. This is one. It does work. While uncertainty abounds in our industry, nothing can impact the value of your business if the relationship with your clients is established and maintained on a framework of transparency, authenticity and two-way honesty. It's got to be now. It's law. You want your service to be valuable to your clients, but also valued by them. And when that happens, you have created a sustainable, transferable business, and it is highly valued. You just have to hit the start button at some point. Here's a disclaimer that we must add. I apologise for rushing through stuff for you all out there. Please forgive that. You will get a copy of this. If you want to do anything yourself, go for it, but please be disciplined about it. And if you want to have a chinwag with us, then we're available whenever. Liam.
Thank you so much, Rob.
Sorry. Yeah.
You can take a breath now. Awesome presentation. Listeners, we hope you found that extremely valuable, that discussion on fee models and extracting latent value that is there in your business. If Rob doesn't mind, we might stick around for a few minutes longer to try and get through a couple of questions.
Sure.
Guys, it's your last chance. Question box on the right-hand side, get them in, and we'll try and whip through them in the next 5 minutes or so as quickly as we can. And for everyone who's asked for if you'll be receiving a copy of the recording and the slides, yes, you will. There's an email going out within the next week. So just keep an eye out for that one, and they'll all be there for you to revisit. And yeah, if you've got to run, if you exit the webinar now, the feedback survey should appear, so we won't punish you for leaving question time beforehand. So, well, we hope you stick around. We've got a question here, Rob. Advisor's just recently bought some trail books. In light of the Royal Commission, he's wondering, are they worthless now, or?
Great question. Yeah. Well, so right now, as we speak, 4 firms, out of the 13 that are still in implementation phase have acquired a trail book over the last 2 years. Obviously, it depends on what the trail book is what makes up that book. Unfortunately, our assessment of those firms and the particular book they acquired was that 50% of it was valuable, 50% was not. And I know that might sound a bit harsh, but from our assessment, where we do our low quality revenue assessment, half of the revenue would not make the grade. But the other half was definitely valuable to the point that those clients could have been represented with a service proposition, had that valued, and the client would have come on with the firm as a active ongoing client. The problem with some of those acquisitions, and I'm not sure of the particular one you're talking about, some of them came with conflicted REM, some of them came with passive income, unserviced clients. So how do you know the clients have been serviced? Don't count it if they haven't been serviced, because you'll have little chance of resurrecting that. So it's probably not the perfect answer, I know, but 50% of the 3 acquisitions that firms that I'm dealing with have done, 50% was valuable, 50% was not. But again, there is hope that in the trial book that was acquired, the 50% that could have been serviced as a typical active client on an ongoing basis, that the right fee put to them could well and truly extinguish some of the fees the other clients came with that will be turned off at some point in time. So if they're active clients, fantastic. If they're not, there's issues.
Fantastic. We've got one here about, sorry, just lost it. Yeah, insurance. How advisors should price insurance moving forward. It's only going to become more important.
Yeah, no, it's great.
Any advice on that?
Yeah, risk is. So I hope I don't cut myself off here, but risk insurance, we have been, not pressured is the word, but rightly pressured by some clients of ours where they've got, let's say, a third of the business is risk, or even 50% of it's risk, and they've seen what's happened on the planning side in terms of a revisit of the value and pricing, etc. They've asked the same on the risk side. Could it be done? The short answer is 100% it can be done. Where there is a value, as I said right at the outset, where there's a value to be created, a service to be created, we can put a price to it and we can have a client pay. I don't come from the school of clients will not pay for risk services or a fixed fee, I should say. Well, I do. And I know others that do, and I know some firms that we've come across, fantastic firms whose clients do. I realise how challenging it is, though, because the insurers, the underwriters haven't played ball at this point in time, but at some stage very soon we are going to have an implementable model for risk insurance, and we will deliver that, and we hope that you could engage with us at that time. I haven't got it now, to be honest, but we are building it, and we will get there in the end. And again, I pay fixed fee, and I pay fixed fee because my advisor adds value to me on my risk. That's as simple as that, and I recognise it, I can identify it, and I pay for it. But not everyone believes in that. That's fine. I'm not here to convince you. I'm here to answer the question, could it be done? We will do it. We just haven't got it fully automated yet.
All right.
Sorry.
Folks, I know you have a ton of questions, but unfortunately we're going to have to cut it off there. We'll finish with one final one, which seems to be a common theme throughout, which is there's a lot of people interested in the Peloton service. What is your fee structure? How can people get in contact with you?
Yeah, okay, so fees, so there's 2 things. iFocus is a review of your business that you saw before. That's a fixed fee. Anywhere between $10,000 and $25,000 a firm will pay us for that. And that's important. It's the deep dive, it's the facts. It tells us whether or not you can successfully then engage in an ongoing I deliver strategy and, deal with the client pricing issues that are embedded in your firm. So a firm that's very complex will obviously be at the top end, and we've got several of those as we speak now, but there are others that will be at $10,000. It depends purely on what your business looks like and how complex it is. In terms of doing the job, so the project, we run it from start to finish. So if there's, this is I deliver, this is the doing bit of the iFocus, where we work out in iFocus whether or not there's an opportunity for you, and what exactly that opportunity is, we pinpoint, and in iDeliver we set about doing it. That is a fixed fee plus a performance-based fee if we hit our mark and deliver what we say we'll deliver to you. That fixed fee, for many firms now, I put it out over 2 years to pay it on a flat fee, per month basis. I don't really care, to be honest. We don't charge anything up front. It's just as the project unravels. But I will tell you, and that fee is a good fee, make no mistake about it, but we do a hell of a lot for it. So just a simple explanation here, we've got one firm at the moment who is targeting $500,000 in uplift. That will happen probably within 13 months, we've worked out. They will pay a total fee to us somewhere around $250,000. I know it sounds a lot, but they're investing into something that has a guaranteed return. If it doesn't have a return, it's a cost. If it has a return, you're investing into it. That just gives you an example of one, but that's paid out over 2 years, of course. But the uplift itself covers that fee at around about month 9. So it actually becomes you don't even have to budget for it in some firms' cases, but everyone's different, and we make sure the fee is fair and reasonable, and that's how we do it.
Well,
and you can contact us, Peloton Partners, via the email. I'm happy, I think, if you want to stick my mobile on the presentation, Liam, that's your call. I'm happy for anyone to give us a buzz and just have a chat if you want. I'm sorry I had to rush through it. I really do. There's so much in it, but I didn't have much time. My apologies.
No worries. And yes, we will try and add those contact details to the presentation in the slide pack that you'll receive. Rob, thank you again. Awesome presentation.
Thanks,
listeners, thank you again. Thank you for joining us. We'll just finish off with a couple of key points from us. A reminder that to get your 1 CPD point, when you exit this webinar, there will be a feedback survey. Please complete that. That will be included in the website and an email that you will receive within the next week, which will also include the recording and the slides from this presentation. You may also be interested in a couple other things we have coming up. We have a technical roadshow touring all around Australia, all the major cities, Toowoomba, Hobart as well. That's complimentary, 3 CPD. There'll be an invite link to that in the email that we'll send around. Please register. It will be discussing alternative technical strategies to help you get the most out of super for your clients. And we will be joined by Invesco's head of consulting, who is coming from the US, who will also share research-based insights on how advisors can better communicate their value to their clients in a price-sensitive environment. We've also opened up our portfolio construction webinar to advisors, so please join that as Roger Montgomery presents his economic outlook and opportunities, investment opportunities that is in the market for the year ahead, and that is also CPD accredited. If you haven't seen before, check out our innovation toolkit, which is available on our website. That's just got resources to help you and your team innovate effectively in your business. Which includes some awesome workshops, which we highly recommend you check out. And with schools starting, I have to plug our sponsorship of Banker. They promote financial literacy in schools. They got this whole virtual economy software where kids can learn the basics and a lot more to improve their financial capability. We are committed to sponsoring 15,000 kids on that program. So check out our website. You can refer a teacher and get your kids on board with that in school. Again, thank you very much. We hope to see you next time as Dante DeGori from the FPA will be discussing all the fallout and the repercussions from the Royal Commission Hayne report. Have a great day, listeners. Thank you for joining us. All the best.